So this is the Discovery Metals. We're focused in Mexico, and our flagship property is the Cordero Project. We were named to the, as you'll see from our title page here, to the Venture 50 last year in 2020, which was really proud to get that honor. I'll move forward. Forward-looking statements will be made in this presentation. And getting right to it on slide 3 is what are the 2 key points that we want to leave you with here. So what are the reasons investors should be really looking at Discovery right now? And there's 2 things. One is our exceptional leverage to a rising silver price, just because of the sheer size of our deposit, which is over 1.5 billion ounces of silver equivalent. We are one of the world's largest undeveloped silver resources. Just because of that sheer size, the leverage is very much unparalleled, and we're in a very good jurisdiction as well in combination with that. And what's the second point, in addition to leverage, is the fact that how do you add value to share price? One is leverage to the leverage to the commodity price. The second is drilling and adding value by optimizing a very strong project and being funded to be able to do that. We have over $40 million of cash in the bank. So we've got the ability to add value through the drill bit as well. And we've been putting out every month or so drill results press release that's been showing some very, very strong results. And we hope to continue that very regularly through 2020 and into 2021. Next slide here, you probably have seen some form of this over the last little while, but it shows the behavior, the share price behavior as a percentage change of silver and gold over the last 4 precious metals bull markets. And you'll see, as much as gold is slow and steady, you can see silver takes a while to react, but it consistently in each of the cycles materially outperforms gold. And we're in that 4th cycle here, 2018 to who knows when, and silver's been lagging, and I'm sure that'll be a major discussion in our panel, but we really think it's silver's time to shine. And again, considering the leverage we have and the position we have, being able to aggressively drill, we think we're in a great spot. So just a quick snapshot of the company. The basics of Discovery Metals. Our flagship project, as I mentioned, is the Cordero Project. It is a PEA stage project. The Cordero Silver Project is located in Chihuahua. It's located in a very prolific area, a major gold-silver belt. You can see here on this image, there's just a few of them, but there's many long-lived, robust mines, nearby and on this same belt as well. We're on the western edge of the very high-grade CRD belt that Peter spoke about. Very well-known Mexican CRD polymetallic belt. So we're in a very good location geologically. Very clear. Cordero is also the 4th largest undeveloped silver resource in the world. That's by SNL Metals and Mining, and in our deck we've got a list of all the other ones there, and that's just with silver alone. So that does not include any of the other credits. Just silver alone, the 4th largest undeveloped silver resource. And as I mentioned before, we're aggressively drilling. We've got a 35,000 meter drill program that will probably be up. So 35,000 meters for 2020, and then well into 2021, we're funded. But our main aim in this is to completely look at the Cordero Project in a completely different way versus the previous operators, which was Levon Resources. We are looking at showing and optimizing a project that works at current silver prices, and has the upside and the optionality of silver takes a run to get larger and larger, and not just on a margin per ounce basis with the resource that's there. The resource gets significantly larger as silver price rises and or as CapEx is paid off, and you'll see the deposit geometry is very favorable to staged expansions and for the ability to expand. This really can keep getting larger and larger, and Forbes will get into that. Other key point I mentioned, we've got close to $42 million in the bank as of this week, and we're funded for at least 2 years of aggressive work, probably more. And our kind of main catalysts are to get a brand new, completely new resource out by about this time next year, and then followed subsequently by a completely brand new PEA for the Cordero Project. Those are two key focus points. Moving next on to slide 6 is, as many of you may know, we are part of the Oxygen Capital group of families. Oxygen is an integrated merchant bank and mining house, and started by the founder was Mark O'Day. The 4 active companies are ourselves, Liberty Gold, which is focused on the Great Basin, and Pure Gold, which is focused on bringing the Madsen mine to production, very close, and Sun Metals, which is focused on polymetallic project in BC. Oxygen is the founder and cornerstone shareholder of Discovery, and they have had serial success over the past decade, maybe even a little more. They've sold 5 companies over the past decade, as I mentioned, and they're listed there: Frontier Gold, True Gold, and they've just been able to attract capital and keep shareholders and bring in new shareholders just because of the success that they've really had. And you know, they often say it's the second or third operator on a project that really makes the asset work. And Oxygen, I think, you know, really has shown it as the innate ability, the unique ability, to be able to take an asset that has lots of data, because data is very important, technically very credible group, but take the data and look at it in an entirely different way and really make it successful. And that's what they've done in many of the cases that I've spoken about. The other key shareholder has been a great and supportive shareholder, is Eric Sprott. Eric Sprott now owns about 24% of Discovery, and as you all know, Eric is very much a big fan of silver, precious metals in general, but he definitely makes a strong case for silver moving very strongly. And you know, he really likes the leverage we bring, and the fact that he's worked with us in previous companies and our team. He knows us pretty well. But simply, you know, he says, you guys have 1.5 billion ounces of silver in the ground, silver equivalent in the ground. You know, that's, no one can really match that out there. So that's a big thing why Eric really likes the name. And also to point out the fact that this isn't a well-known mining jurisdiction in Mexico, not in some remote location that requires huge capital to get there. And we'll have to go into that about the infrastructure, but it's a deposit that can actually become a mine. Very clear to see that. And let's go to the next slide. Forbes, I'll pass it over to you.
Yeah, thanks, Taj. So, yeah, just to carry on with that theme, that infrastructure theme, I think this is just a plan map of our land package, and that little sort of red blob you see in the middle there, that's a PEA pit outline from a study that was done in 2018, and that's pretty much been the focus of all exploration activity on that land package. We do know there's multiple big intrusive centres elsewhere on the property. We haven't done, there's been minimal work done to date on those targets, and on the back of this recent financing, it's certainly something we're looking forward to getting a bit more aggressive on. We do have 100% ownership of the land package, so no messy sort of option agreements. And then just sort of circling back on that infrastructure point, this just shows you a satellite image of that same land package, and you can see there's a sort of main road coming down one side of the land package, and we've got a power line coming down the other. So certainly an ideal situation from an infrastructure point of view. And then this is northern Mexico, it's Chihuahua, one of the mining-friendly states. And you can see you've got that classic rolling topography, which is certainly ideal for open pit mining. Just down the road is Parral. Those familiar with the Go Gold story, they're actually processing some of these tailing facilities on the edge of town from an old mine that was basically formed around the town. So this is a mining town, and certainly for us, a great source of skilled labour as we try and advance our project. Okay, I'm just going to take a step back a bit here and talk about this. We'll talk about the 1.5 billion ounces, and it's a number that gets thrown around a lot, but this was based on the 2018 resource estimate that Lavon did. So this was a predecessor company that we acquired the asset from. So this 1.5 billion ounces, I think the key thing to keep in mind is that they applied a very low cutoff grade to that of 15 gram per tonne. So at that low cutoff grade, the average grade of those 1.5 billion ounces is about 40 gram per tonne. So low grade, but certainly if you think silver's going to $25, $30, I mean, you get exceptional leverage because those ounces should be economic at those higher prices. But when we were doing our due diligence from an M&A point of view, our focus was really, is there a project here that works at $18 an ounce silver? And so all our due diligence was really looking at everything above a 50 gram per ton cutoff. And you can see at that higher cutoff, there's still almost 700 million ounces of silver equivalent. And then the average grade has gone from that 40 gram per ton, and now you're north of 100 gram per ton silver equivalent. So from a project advancement point of view, this really is our focus, trying to show there's a high margin project that works at $18 silver while still ensuring we retain that leverage to the silver price if it does move higher. So how are we going about that? We're about halfway through this phase 1 drill program. We've drilled about 18,000 meters. As Taj alluded to, now that we've added firepower from this recent financing, we'll probably look to expand that drill program by 10 to 20,000 meters, especially given the excellent results we've received to date from our drilling. So that work will culminate in a new resource model in the first half of 21, probably towards the end of the first half. And for the first time, that model is going to be capturing geology and structure. And the previous model was a grade model, so it was more just reliant purely on the drill data, but also to create a robust, defensible resource model that you can generate a solid mine plan around. We're going to be incorporating those additional details to make sure it's a high-quality resource. On the metallurgical side, we know from previous test work the metallurgy is clean. There's no nasties. It's just going to produce a simple lead con and zinc con. We do feel there is room for optimizing the flow sheet, so we're going to be starting some met work probably in the second half of this year. That met work plus a new resource model will result in a new PEA around the first half of next year. I've talked to the property-wide targets, so that's something we're obviously looking forward to moving forward more aggressively as we advance those targets through the course of this year and hopefully be drilling within the next sort of 6 to 12 months. This small little footnote here, it's hard to see in this presentation, but we did ramp up drilling to 1 drill rig in June. We're hopefully be able to quickly ramp up to sort of 2 or 3 rigs. We're monitoring the health and safety situation around the COVID risk, but just a flag, these timelines we are mentioning is subject to how quickly we can get fully ramped up from an exploration point of view. I'm just going to show now a plan map of pretty much all the drilling that's been done on our property. And just as a frame of reference, this is the sort of PA pit outline. And to get a feel for scale, that's more than 2 kilometers in that direction and over 1 kilometer in that direction. So for those familiar with Detour Lake, that's not too dissimilar from the ultimate pit at the Detour Lake mine. So we're dealing with a very big footprint. Our drilling initially, we were focusing this positive plateau zone in the southwest. We knew it was very good grades near surface, so we wanted to get a good understanding of the controls of mineralization. And then armed with that knowledge, we've since been stepping out sort of along that north corridor as well as drilling some holes in that south corridor. Our most recent press release, we released hole 319. So this is the most northeastern hole we've drilled. We actually got one of the best intercepts on the property, 170 meters of more than 200 grams silver equivalent. So certainly we're getting very good results as we step out beyond this initial starter pit. And these holes in green here, they're the ones, their assays still pending. So we're hopefully going to release those in the next 2 or 3 weeks. So I'm just going to step into a 3D model here of the project. And just as a frame of reference, this is this exact same plan map we were looking before. So I'm just going to drop the plan map off and show within that PA pit all the mineralization that is above 15 gram per ton. And so this is based on the 2018 resource model. I'll just drop off the satellite image just to sort of clean it up a bit. But you can see within that footprint there, again, huge footprint, but pretty much everything within there is mineralized. So when we talk about that leverage to upside silver prices, this is what we're referring to. In terms of our focus, again, we were looking at everything above 50 gram per tonne. So I'm just going to show this exact same image, but looking at all the blocks that are above 50 gram per tonne. The blocks in green are indicated and the blocks in blue are inferred. And so it shows you there's still a huge volume of material within that massive footprint that is good grade. And what it also says, what also shows is certainly down in the sort of positive platter zone and adjacent to it, there's a lot of good continuity of good grade. I mean, that from one end of that trend to the other, that high grade mineralization, mostly indicated resource, I mean, that's almost 1 kilometre. When you sort of move beyond that zone and sort of start heading up to the northeast and the east, you can see there's a lot more gaps, which are ultimately waste, and there's certainly a lot more zones that are classified as inferred. So,
and that's a good point there. I just want to point out that we're drilling all in that big ultimate pit, a huge pit, but it's not necessarily infill drilling here. There's huge spacing between the holes as you move northeast. The southwest is drilled quite well, and you can see that the green's indicated, the light blue is the inferred. But even where we're drilling, as we step into the northeast, there's areas that were defined as waste, and we put a hole in there, and all of a sudden it's higher grade ore. So that's really where the value and the optimization is coming, is going to the areas that weren't drilled as densely and continuing and to expand the high grade core.
Yeah, and really just to emphasize that point. So now I'm just going to show an image. These are all the historic drill holes in grey, and I'm just going to add our drill holes in black. But I mean, exactly to that point Taj mentioned, you can see in the sort of southwest, much tighter drill density at about sort of 30, 35 metres. But once you sort of head out in these zones here, we're talking sort of often 200 to 300 metres between drill holes. And so obviously just that lack of drill data is driving a lot of that waste classification in those zones. If we then look at just the raw drill data, and okay, let's have a look at what those holes in that area are actually intercepted. I'm just going to bring up all the composites or all the assays from all drilling that is above 50 gram per tonne. So again, we know sort of there's this nice attractive zone here at the start, but even when you look at these zones in the northeast, you can see there's a lot of intercepts here. Very good grade. Again, this is everything above 50 gram per tonne. Very good grade with excellent continuity. So obviously, if we can come in and plug up some of these gaps and show that there's continuity, I mean, we're ultimately converting waste to ore. And to give you a feel for the economic impact has, I mean, you consider, say, mining costs of $2 per tonne to mine waste and drop it off on a waste dump. But if you convert that waste to ore, all of a sudden you're turning that cost center of $2 a tonne, if you put it through the mill, to a profit center of anywhere from $10 to $20 a tonne. So the delta on the economic and cash flow impact is huge by doing that. So this is the sort of work we're doing at in terms of defining out and focusing our drill targeting. We're looking at these pit optimizations early on so that when we do put out the resource in the PEA, we're going to have all the appropriate data to make sure we're optimal economics. So I'm just going to jump back into the presentation here, and I'm not going to get bogged down in the geology side of things, but I would just flag a lot of these intercepts quoted in this table. And so the only holes we've drilled are sort of these 3 holes here. All the other holes were drilled by Levon, and I think the obvious question that often gets asked is, okay, well, how was this missed? And it wasn't missed. These were intercepts that they hit, but it was a different commodity price environment, and their focus was creating a very big, large-scale operation, a sort of Penasquito type mine. So our focus is very different. Like I said, we're probably looking at a stage expansion around the high grade and then push back into that low grade mineralization. So it's just a different approach. I will mention one thing I haven't touched on yet, and I'm just going to jump back to the plan map here, but these red trends along our footprint here, so they're vein trends, and we know they're vein trends from all the historical working. There's been historical underground working that's been done on the property decades ago. And you can see the strike extent. If you sort of total up all these vein trends, you've got more than 5 kilometres of strike extent. So these veins have never been drill tested, specifically drill targeted through drill programs. They've been intercepted through obviously targeting that more bulk style tonnage mineralisation. But when you look at the results when they have been intercepted, I mean, you can see we're talking sort of kilogram per tonne type numbers. And so we're now, with the added firepower of the financing, going to dedicate a lot of drilling activity to try and focus on targeting these veins. We know there's good grade. There appears to be good strike continuity. So if we can demonstrate there's good width to these veins as well, then you've not only got the bulk tonnage story, but then you've got a lot of icing on the cake that's going to come from some very good grade material from these veins.
And you can also see, Forbes, if you could put it back on the plan map, Lavon really, they had a tiger by the tail at the time, and they just really focused on this pit area. And outside of the pit area, there's at least 30 or so workings outside the pit area that continue along the northeast direction. We haven't gotten to them yet. We've done some early reconnaissance work, but those veins could conceivably continue along strike there. Really, the veins were not a focus. This was looking for big bulk tonnage, Penasquito style mineralization. Any of the veins that actually fell within the big pit were kind of considered as part of the bulk tonnage. We are going to model them separately. In fact, the old model actually by Lavon was an assay model, grade model, and we're going to be using geological constraints, structure. We're going to have domains. It's going to be a lot more of a tightened up model of a different way again of looking at it. And we expect tonnage to come down, sure. Forbes talked about the 50 gram per ton case at a couple 100 million tons. We expect maybe the tonnage to come down in what we're looking at, but we expect the grade to come up, and that 110 number you saw, gram per ton silver equivalent. So keeping the metal pretty consistent, bringing the tonnage down, but the grade up. Hopefully keeping all the ounces there. That's really what our focus is. And these veins have really not been looked at. And we know that there's two kinds of mineralization, as Forbes talked about. And the main one is that bulk tonnage breccia hosted mineralization, the sulfides in the breccia. And then the second kind is the sulfide veins, and they've never really been looked at separately. And who knows, this could be a high grade open pit with several different veins being mined by underground methods, or who knows? It's early days, but we really are going to look to work at optimizing this as much as we can in terms of the economic perspective.
Yeah, thanks, Taj. So look, this is just another view of the sort of PEA pit outline. This is just a long section through that pit. And all I really want to emphasize here is that just the geometry of the high grade that's been defined to date is certainly ideal from a mining phase point of view. So your logical first phase is sort of come in here, go after that sort of good grade stuff near the surface. Anything that's yellow or warmer is above 50 gram per ton. And then as you sort of do your second and third phases, you're sort of pushing back into sort of some of that. Sure, there's still high grade zones in there, but just doesn't have that grade and continuity. But again, a lot of the time, that's just due to lack of drilling. And so that's sort of where we're focused at. But in worst case scenario, the high grade zone would have been situated down here. And so you're going to strip all this stuff, stockpile it, and then mine it. We're very fortunate, based on what we know so far, is that most of the high grade is pretty close to the surface in that southwest corner.
Yeah, the thing that really attracted to us, if you could, Forbes, go back to that long section, this was a bit of our light bulb moment, but it's like this high grade approach we're applying to this project, this staged approach, is what you would have done anyway. But we're completely changing the way we resource model from this point of view, the way we mine plan from this point of view. We want a project again that could work and be a significant mine for a mid to a major producer, just as it is. That's what we're calling that starter. And then the rest of it is all upside as CapEx is paid off, as silver price goes up. And the deposit, again, is so amenable to the pushing back into ore. This whole pit that you're seeing here has about 420 million tons of ore in it. Those light green and light blue areas are not waste; those are ore, just lower grade. But as you've paid the capex off, and you've gotten all your economics from those first few phases, you can continue to go into lower grade ore, but capex is paid off, the ore still has high margin. So it really kind of was that light bulb moment for us.
Yeah, and obviously that just feeds into the work we're doing on the PA side of things. And look, I'm not going to spend too much time talking about the old PA. It was certainly done in a sort of different commodity price environment there. And again, just a different vision. It was a low cutoff, so the head grade was pretty low. As a result, there was a sort of big mill that was put in place or assumed, and then as a result, you got a capex almost 600 million. So our focus is probably look at it starting with a 10,000 tonne per day mill, and even if you assume, say, a head grade of 100 gram per tonne, that's still north of 10 million ounces silver production a year. So that's still a top 10 silver mine globally. And I think it's, when we talk about the starter pit, we've got to put some context in there. It's still, there's a lot of tons sitting in there. Like I said, that starter operation is still a top 10 silver mine globally. So, but then once the capex is paid off, look at going to say 20, 25,000 tonne per day. Once you sort of push back beyond that initial sort of higher grade zones. So that's our focus on a PA point of view. And again, it's going to be all based around what we feel will be a very robust defensible resource model that's going to capture geology and structure as well as the drill data.
Yeah, a couple of points I want to make here is the numbers that are key to us is NPV to CapEx ratio of better than 1-to-1. That's what we're striving for. Hopefully a lot better than 1-to-1, but IRR is a very important number to us. Payback, these are the numbers that are very, very much going to be important because the NPV, as you see here, is high. It's 700 million. And in fact, it's slightly even higher than the CapEx. But that's at $20 silver. We, again, want to make this thing be a very strong, robust project at current silver prices. And we think there's a lot of ways to do it. It's a world-class project. It's a huge system. The metallurgy is clean and simple. Quite a bit of met work's already been done. It's important to know. Very simple sulfide metallurgy. Almost all the silver goes to lead con, where you get the highest payabilities. It ticks all the boxes, infrastructure, etc. And what really set this apart was there's a project that actually could be its own project at $17 or $18 silver, and then you've got all the upside. So that's what really, again, using a lot, but that light bulb moment for us was we can show there's a project here now that works, and we've got all the optionality.
Right, Taj, let's let you wrap up the last two slides.
Yeah, there's 2 slides left here, guys, and basically showing what the next 18 months look like. We're going to continue our phase 1 drilling. We'll be starting here in about a week, again, ramping up 1 to 2, and then just before COVID, we're at 4. So that's our ultimate goal, to get to 4 or maybe even beyond. We're also in the process of re-logging all the historic drilling because we're completely doing a revamp of the resource. All of the old holes, 292 of them, have all been re-logged. We're about 70-80% of the way done. That'll be important for our domaining. And then into the second quarter now moving, we'll continue our phase 1 drilling again of the breccia area. We'll start beginning work on the underground vein workings, which we talked about. And then we'll be doing the property-wide work, doing some recon work, some mapping and sampling to start building those targets up and getting ready to potentially drill those in the second half of the year. Drilling will continue, some early stages of engineering, resource work will be continuing on through the year. And in the second half, and then first half, as I said, the ultimate kind of the goal we're working towards is the resource estimate in the PEA. And then hopefully, $1.5 billion tons of mineralized ore on the property. We're hoping there's another deposit there. It's just we're sitting on about 1,000 hectares or less. We've got 35,000 hectares around us contiguous, and hopefully with a system that big, there's some more Corderos hanging around. So we're going to be very busy on this property, and we're just in a great position, I think, here, being funded and in a rising silver price to really adding value. And then the last slide shows the capital structure. You see our market cap's hovering about 200 million or so Canadian, and we've enjoyed some pretty positive momentum of the share price over the past 4, 5, 6 weeks. Silver going up, us being funded, people really taking a look and seeing this thing is for real at these prices. Yeah, we've been just enjoying very good volume and also share price appreciation. shareholders, we've talked about it before. Eric Sprott owns 24%. Retail is about 38%. A lot of it's in the U.S. as well, definitely with the silver look on things. Institutions, backed by a lot of strong institutions, are at about 25, 26%. And then we've got skin in the game. Founders, management, and board are at 12%. We're all there. We all believe in this and keep pushing it ahead.